So I'm looking at what we call IAS 12. So IAS 12 is all about income taxes. It's all about income taxes. Specifically, I'm going to look at what we call the deferred taxes. Deferred taxes here. We're going to look at what we call the deferred taxes. Deferred taxes. All right. So then what we're going to do, as we agreed, Mwalimu is going to play some little video here, and then we shall be able to do a very good live recap, So for now, for about 20 minutes or so, you guys are going to watch a video. And this video, I'm putting it a little bit higher speed. Very important. We add back because you see it's a lot. Sorry, just a minute. And because it is highly tested in your exams, it will be very... Okay. So this is the video that we are sharing here. Now, ladies and gentlemen, this video, I'm playing it live from your learning management system. Remember, at RCM, we have a very, very great learning management system where we put videos here. All right. And the most important thing that I would want to sell to you today, please, if you're an RCM student, you should not be watching your videos here at a lower speed. You know, for example, when you come here to these settings, all right. So you'll be able to see in this case here, settings here, you can see there is something to do with what here with speed. If the topic is very, very new to you, you shall always watch it at 1.25 and not normal. 1.25, you're able to save a quarter of the time. And then, of course, as you get used to this LMS, higher speed, you shall be working with 1.5. At the very highest, it should be 1.75. Nobody should ever use 2. So today, I'm going to use 1.25. But in between, should you feel that the speed is very, very high, please ensure that you are raising that with me so that I can lower. But trust you me, 1.25 is similar to, is very, very close to normal. Very, very close to normal. All right. So then as we progress, please always ask questions, make contributions, give us answers, and in between, I'll be able to pause to even do better explanations. So when I'm watching this again, I have to put this to full screen. So even if it's a phone I'm using, it's always important to put this into full screen like that. And then now I can play. So you can see the title is IAS 12 Income Taxes. It's a topic you guys did in financial reporting intermediate level. But here I will assume that you never did it. We're going to start from scratch. So let me share the sound stereo like that. Great. And of course, at this juncture, before I start playing this, I would want to welcome all students, in this case, who are doing AFR and other papers of CPA to join RCM College. All right. If you are interested with our classes, our number is 0719 525 1000. 0719 525 1000. We have a great model, learning model, which will be of help to you. So there I am, and I will go now silent until I post the video. Very important for us to appreciate this concept of income taxes, specifically on this deferred tax. Deferred tax. As you're going to see, ladies and gentlemen, deferred tax normally arises from who? It arises from temporary differences. From temporary differences. So anytime we talk about deferred tax is tax that will not be able to pay this year, but for sure, it is simply because of what we call timing differences. In this particular case, I would want you to appreciate that there are those expenses that you may incur this year, but the taxman will allow you to claim tax against them next year. So you can see in this case here, then at the end of the day, the taxman will allow you to claim input tax. But of course, he's not allowing you to claim that input tax on the very year that you incurred that expenditure. So we have in this case here what we call timing differences, temporary differences. These temporary differences are the ones that will be giving birth to what we call deferred tax. So we shall see what we shall be doing. We shall, ladies and gentlemen, in this case here, come like now in Kenya, of course, we'll be given the tax rate, but in most cases,
To calculate deferred tax here, we shall come and take 30%. 30% over all the TDs, TD is temporary difference. TD is temporary difference. So you calculate temporary differences for all your events, and then you take the corporation tax rate, which is 30%, or whichever tax rate which the examiner gives you as the corporation tax rate. That is what you use. So you take 30% times temporary differences. As we're going to see, ladies and gentlemen, as we get along, there are some expenses that you will incur. Put them in your income statement, but you can never claim any input tax against them in future. Those expenses, we normally refer to them as what here? As permanent, or rather they will lead to what we call permanent differences. So whenever we talk of permanent differences, you're always supposed to remember that these are those expenses that you incur at any given time. I've incurred these expenses, so I'm putting them in my income statement, but the taxman will never put them in his tax base. He'll never put them in his ledgers. So those expenses that lead to what we call permanent differences, number one, they don't help us in calculations of what year? Deferred tax. There is no any deferred tax consequences from such expenses in the future. Remember, deferred tax is tax we shall be paying in the future. We're basically taking it to the future, given what we call the timing differences. They are those expenses that you incur in the current period, but you will never ever get a chance of claiming those expenses from your tax payable. Never. Those expenses are also known as what here? Disallowable expenses. I know you guys are great people in terms of matters of tax. Can you kindly give me those expenses that you know that these expenses are disallowable? The taxman, even in the very future, he will never allow any amount in a card in the name of those expenses to be claimed. Is there somebody who is able to give me just two expenses that you guys know that this expenditure have been incurred? You will never ever claim any input tax against them in the future. They're saying depreciation. Depreciation to me is simply a matter of timing differences. Because you are claiming depreciation, but the examiner or the KRA will also be allowing you to claim that depreciation, but using the wear and the tear allowance schedule. The figures could be different, but for sure, for depreciation, you are going to be claiming your wear and the tear allowances. So in terms of deferred taxation, depreciation is just a deferred expenditure. It will be allowed, ladies and gentlemen. So like now we have donations. When you donate, of course, nowadays they have started bringing up the issues of what here, issues of like, this is a registered charitable trust. But for now, we should always take that the donations, we have in this case here fines, those penalties that you go and for example, you are overcharged. You are charged the penalty because of some undoing. You know, those penalties, you can never claim anything against them. Never. So those kind of expenses will fall under what we call disallowable expenses, which will lead to what we call permanent differences. Once you incur it, that is it. In the future, nothing will happen to this particular account. It's frozen. To help us understand our today's topic, I would want us to open, ladies and gentlemen, What are we opening here? What we are opening, ladies and gentlemen, is quite a straightforward question that I would want us to do today, which is on which sitting here. This now is on which sitting? September 2011, question number 3. September 2011, question number 3. September 2011, question number 3. I will start with Roman 2. I'll start with Roman 2, but of course I'll go to Roman 1 for description. So once you are able to get this question, can you kindly, ladies and gentlemen, put your thumbs up like this? Kindly put your thumbs up like this. Kindly put up your thumbs like this. September 2021, question number 3. My friend Paul, once you get that question, or any other student who is here, once you get that question ahead of everyone else, please send it to our WhatsApp group. Abracadabra. So September 2011, question number 3. Roman 2. Question number 3, 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 Roman 2. Once you get it, are you able to put up your hands and give me a signal that, hey, you know what, Mwalimu? Thanks, Hesbon. And I hope Hesbon shared. Thank you so much. So Roman 2. We are reading this together. Huruma Limited A public limited company has a portfolio of investments, has a portfolio of what? Investments, including various subsidiaries, and also undertakes various projects varying from debt factoring to investing in property and commodities. The following information was extracted from the group financial statements relating to the deferred tax provision for the year ended 31st March 2021. Number one, Huruma Limited acquired a controlling interest in a subsidiary, Sukari Limited, on 1st July 2020. The fair values of the assets and liabilities acquired were considered to be equal to their carrying amounts, with the exception of freehold property, which had a fair value of 256 and a tax base of 248 million. If I were the one doing this in an exam, I'll actually start by reading the required, so I can do the question as we get along. So required, determine the deferred tax asset or liability for Huruma Group as at 31st March 2021 in conformity with IAS 12. So whenever they tell us to compute the deferred tax, the very first thing you need to do is to compute what we call temporary differences. What we call temporary differences. So, ladies and gentlemen, how do we get temporary differences? Very easy. How do we get temporary differences? To get temporary differences, this TD, anytime they want you to get temporary differences, this is how we shall be calculating temporary differences. So temporary differences TD will always be equal to carrying amount minus tax base. Carrying amount minus who? Minus tax base. Carrying amount minus the tax base. This one we shall be calling it CAR. This one will be our TB. Carrying amounts, of course, these are the amounts that you put in your financial statements, reflecting, of course, the values of assets. So basically, this is you as the accountant. This is the taxman here, the taxman. So then in this question, I would want and a TB like that. Let's introduce two columns, and then we attack one item at a time. The first item they have told us, ladies and gentlemen, there is a freehold property. The first item they have given us here is called a freehold property. Freehold property. So freehold property, are you able to see the figure of freehold property? Are you able to see the figure of freehold property? It has been given to us. This has been given to us. Freehold property, this has been given to us in Roman 1, in the first note. Freehold property has been given to us on the first note there. So freehold property, they've told us the carrying amount is 256 million. So I can put my figures in millions. So 256. Please remember, carrying amount will either be the net book value, or in this case here, net book value, or what here, or fair value. Net book value or fair value. Fair value is the same as market value. Assuming I've got this kind of a pen, I've been depreciating it. So I have a carrying amount of 10. And then we come, assuming it's an asset, that is, and then we call in a valuer. A valuer gives us a market value of 15. You see, we are required here to revalue assets whenever we have what we call fair value, fair valuation, IFRS 13. So please listen and listen to me very well. Anytime you see a question, talking about, in this case here, fair value, always know that also fair value is your carrying amount, is your carrying value. So in this question here, they have told us that the fair values of the net assets and liabilities in note 1 acquired were considered to be equal to their carrying amounts, with the exception of freehold property, which had a fair value. Fair value is the same as carrying value, and a tax base of 248. A tax base of 248. That's tax base. So now I want you guys to come and create a column here where you slowly give me the temporary difference. So is there somebody who is able to give me this temporary difference? How do we get temporary difference? It's CAR minus TB. It is 256 minus 248. Yeah, temporary difference, I'm being told, is 8, which is very good. Let's now look for the second item given in the question. So the second item given in this question, ladies and gentlemen, item number 2, if we are together, during the year ended 31st March 2021. I should have written this question here. I should not have rubbed the question for the new students who are joining us. It is September 2021. Question number 3, Roman 2. Question number 3, Roman 2. I should not have rubbed that. So you're told during the year ended 31st March 2021, Huruma Limited sold goods at a price of shillings 48 million to another subsidiary, Wingu Limited. You see, they've made a sale internally. All right. So Wingu Limited, and they made a profit of 16 million on the transaction. 40% of these goods were held in inventories of Wingu Limited. Ladies and gentlemen, please listen here. The internal.
Somebody kindly share that question in the group. Can kindly somebody share that question in the group? Joyce doesn't have the question. September 2021 question. September 2021 question. I hope Joyce, you are in our paid up group. September 2021 question. Somebody should be able to share it as just as a photo of that question to the group. And then most importantly, I'm welcoming students here to join our online classes. Our online classes, very good online classes. We give you access to our Zoom classes here and the videos. Like now, I'm playing one of the videos from our learning management system. If you're interested, Dan. If you're interested, kindly get in touch with us. Our number is 0719 525 000. Thank you, Igamba.
Sale is 48. I'm putting my figures in thousands, don't forget. The internal sale is 48. Internal sale. Sales within the group is 48. Internal sale is 48. Sales within the group, 48. There is nothing wrong in selling goods between ourselves. But now we have to be very, very keen. Normally, where we have trouble with these internal sales is when we have some of these units left in stock. Left in stock. So the question is, do we have REES? Do we have REES? REES in this case here stands for remaining intra-sales. So please, in this case here, REES stands for remaining intra-sales. Please write this in full, REES, remaining intra-sales. Remember, they have told us that 40% of these 48 has not yet been sold. So 40% of these goods are well within the group, So how much do we have there? They have told us in this question here. They have told us 40% of these goods were held in inventories of Wingu Limited. So they are still within the group. So 40% of these 48 will end up giving us how much? Remember, REES stands for remaining inventory or remaining intra-sales. So I'm being given here 19.2. So this 19.2 is the value against which you will be able to pay tax. The 19.2. This 19.2, the remaining intra-sales, the taxman does not want any jokes in between. Because he knows that people will start joking that, you know what, these goods that I'm having here, they were sold to me by a relative. They were sold to me by my parent company. They were sold to me by my subsidiary. So there was an internal sale, and therefore allow me to reduce this 19.2 by some, what we call unrealized profit. The taxman does not want jokes around. So the taxman in this case, you never forget this, whenever there are intra-sales, the whole of this REES, the remaining intra-sale, the whole of it. So we have here what we call inventory. The whole of this is what we take here, 19.2 is what we take there. The whole of that. He doesn't want to know whether there are some profits there which are not realized. The whole of that. So anytime you hear about these REES, remaining intra-sales, if I were you, I would have written these in my mother tongue somewhere, that this remaining intra-sales becomes what here, somebody? Becomes my tax base. Becomes my tax base. Now, when it comes to the accountant who is now doing numbers in the office, remember, this is an external accountant. Tax base is the taxman, is at KRA. But now when it comes to you as the accountant who is now doing this mathematics, you know that there is no way you will ever allow yourselves to have profit in stock. We cannot carry profits in our stocks. So here we sold goods to Wingu, who is our subsidiary, and we made a profit out of them. So these guys, in this case here, within the stocks that they have, there is like a small profit there. That profit is not supposed to be there because according to IS2, stocks should always be maintained at the lower of cost or net realizable value. So in our case, we should take stocks to be always maintained at what? At cost. That is what IS2 tells us. Now we happen to be having some profit inside there. Then what do? Ourselves, of course, we shall make some adjustments here. So you must come and give me what we call unrealized profit on stock. Unrealized profit on stock. UPS. You must come and give me what we call unrealized profit on stock. And I know you guys are quite used to this. I mean, somehow used to this. If you can remember very well from your intermediate level, to get unrealized profits on stock, we were taking, in this case here, profit margin times REES. Profit margin times REES. If I were you, I would write this thing, UPS is profit margin times this remaining intra-sales. If I were you, I would write this, and then I'll have a yellow highlighter going through. This is very, very important, and I shall be able to do much of this in group accounting. In group accounting, this UPS, unrealized profits on stock, is profit margin times remaining intra sales. So we shall not apply this formula because the examiner has told us the total profit that was earned. The examiner has told us the total profit. So we are told here that they made this 48 million sales to Wingu and they made a profit of 16. They made a profit of 16. And out of this profit of 16, ladies and gentlemen, out of this, so profit here is 16. If you allow me to just write up here, that the total profit is 16. If the total profit is 16 and we have 40% remaining, so the unrealized profit, unrealized profit here will be the 16 times, in this case here, what is still remaining with us. Remember what you are able to sell out there, like the 60% of goods that went outside there, those goods, we sold them and realized that profit. The profit you have not yet realized is the profit which is within the goods, the intra-sale goods, which are still left in store. So can somebody give me this 40% of 16 and tell me what are we getting from Paul? We are getting 6.4. We are getting 6.4. So from Paul, we are getting a 6.4. What? Yeah, 6.4 is what? Yeah, unrealized. So this is now the profit we have within our stocks, which is wrong from the accountant's perspective. From the accountant's perspective, we shall never have profit in our stock items. So please here, in the carrying amount, what you'll be able to carry your inventory at, you as an accountant will be 19, will be this 19.2, what you have here, minus this UPS of 6 point what here, of 6.4. So is there somebody who is able to give me this inventory? The carrying amount of inventory. You can write here CA, carrying amount of inventory. The carrying amount of inventory. So carrying amount of inventory, is there somebody who is able to give me this figure? So we are getting 12 point what here? We are getting 12.8, like that. We are getting
you guys never responded to that. Remember, you must behave like it's really live. When we are watching a video, we must take this as if we are very live. Now listen, when it comes to this inventory, which has been transferred in between the group, remember, group of companies, according to IFRS 10, a group is a parent and its subsidiaries. We shall be looking at that later. So myself as an accountant, whenever there are internal transfers, and then of course, if it is a subsidiary which bought these goods, at the end of the year, they are not able to sell everything. So it means that automatically there is what we call remaining intra-sales. Remaining goods that we receive from, for example, our parent company, which we have in our stocks. And we are saying as an accountant, as accountants, ladies and gentlemen, if these goods were sold to us at a profit, like in this case, there was that profit of 40, and we happen to be having some of the goods with us, it means we have what we are calling profit that is not realized. So of course, ladies and gentlemen, you and I know that as accountants, profit which is not realized, profit which is not realized is fake. The profit which is not realized, is fake. And if it's fake, ladies and gentlemen, what do we do as accountants? We can never have profit in our stocks. We shall subtract. So as accountants, any profit that is within our stocks, we shall subtract in accordance to the dictates of IAS what year 2, inventory, where we are clearly told that inventory, we should never have what year? We shall never have any profits in our inventory. But you see, the taxman does not want that kind of explanations there. The taxman, you received inventory valued at 19.2. That is what he wants to pick. He will pick in this case here the value at which you receive this good, that because he doesn't want to be cheated. The taxman has been cheated for so long. Because we'll come and tell the taxman that, you know what, out of this 19.2, I mean, when I do my internal calculations, then, I mean, there is a profit of even 15, which is unrealized. So we shall continue understanding this more and more, of course, especially when we do the group accounts. But let's just continue listening, and we get 12.8. Almost finishing. The most important thing as we get along with this is you to get the concepts of deferred tax. And deferred tax should always be the first question that you do. All students in this case, you get a deferred tax questionnaire in an exam, and they do it. And they do it very well. Straight away, you get a pass. You just get a good deferred question. And another one, maybe on IFRS 2 share-based. You do those two very well. And then the theories. And then you get group accounts. You tackle a little bit here, and they're using the free low-hanging marks. And then we have, in this case here, what we call a cash flow, free low-hanging marks. You survive. But deferred tax is something that I would want us to be very good at. Very good at.
Like now we have been made to understand that the carrying amount shall never have a carrying amount of inventory. Inventory carrying amount of inventory, we shall never have profits there. Always you deduct. Thank you very much. So then what are you able to give me as the difference? Yes, number 12.8 minus 19.2. What do we have there? What do we have here? What do we have here? Can somebody give me this figure? Can somebody give me this figure? 12.8 minus 19.2. What do we have here? So we have here minus 6.4. Leave it like that. That's the temporary difference for inventory. Go and read something different. Go to note number 3. Note number 3. We are told Huruma Limited has a portfolio of financial assets comprising readily marketable government securities, which are held as current assets for financial trading purposes. These investments are stated at fair value in the statement of financial position. They're stated at fair value, with any gain or loss taken to profit or loss. These gains or losses are taxed when investments are sold. Currently, the investments have market value of 412, and accumulated and realized gains are 64 million, ladies and gentlemen. I mean, that's very nice. We have in this case here fair financial assets right in full. Financial assets, and they are available for what year? They're available for sale. So they're telling us there are 3. Huruma Limited has a portfolio of financial assets comprising readily marketable government securities, which are held as current assets for financial trading purposes. So basically, you have them as your current assets, but you're not holding them to maturity. You're not intending to hold them to maturity. You're holding them for purposes of, ladies and gentlemen, trading them. We call them available for sale. Available for sale. There are things that I've always gotten, in this case, are confusing. AFR, students, and indeed, practitioners. Practitioners, in this case, I don't know how to handle what we call held for sale investment. Held for sale investments. And for example, we have what we call discontinued operations. You have an operation, you've been continuing with it, but after some time, like now what KCB is doing with National Bank. Now they're looking for a buyer. So it's a discontinued operation. So a discontinued operation, what are you supposed to be doing under IFRS 5? Those are things I'll be coming to. But here, I simply want to draw your attention to this financial asset, not being your ordinary financial asset where you have shares that you would want to, not shares, but like bonds that you would want to hold until maturity. No. These are financial assets that are tradable at the moment. We call them financial assets which are available for sale. Available for sale. Let me ask you a question. Have you written this thing in full somewhere? Have you written it in full somewhere? Financial assets dash available for sale. Don't write it as an acronym like this. Once you become an expert, we'll be writing it as an acronym. Yes. But for now, please write it somewhere in full. So then what have these ninjas told us about these financial assets? What they've told us is that these financial assets here currently, the investments have a market value. Market value is your carrying amount. It's your fair value. They have a market value of 400 what here? Or 412 like that. Or 412 like that. And the accumulated, look at that. And the accumulated and realized gains are 64 million. 64 million. 64 million. So that within this, we have some accumulated and realized gain of 64 million. 64 million. The taxman doesn't want to hear about those things. The taxman would want you, in this case here, to provide to him. Or rather, let me put this very, very well. What the taxman will do, you see inside here, you have an unrealized gain of what here? Of 64. All right. You have an unrealized gain of 64. See there. So in this case here, value, we have the investments, have a market value of 412 million, and an accumulated and realized gains of 64 million. Unrealized gains are never what here? They are never taxed. Unrealized gains are never taxed. So unrealized gains, because they are never taxed, go ahead and subtract them. Unrealized gains are never taxed. Go ahead and subtract them. For your revision, you can mention here 412 minus 64. 412 minus 64. 412 minus 64, which gives me what here? Somebody 300 what here? 348. 348. 348. Unrealized gains are never taxed. So if they are in amount here, simply go ahead and do what here and deduct them. So then we have here 412 minus 348. Can somebody give me this answer? 412 minus 348. What shall we get here? 412 minus 348. It will be that 64, isn't it? It will be that 64, yes. It will be that 64. Please leave.
Kindly listen, let me put this in proper context, that these unrealized gains can only be taxed in the period when they will be realized. So they won't be realized in the period when they are what here, or rather they won't be taxed in the period when they are unrealized. And since we are told that within the 412, we have that 64, which shall of course realize most probably next year. So I would rather this 64 be transferred to the temporary difference. Because remember the definition of temporary difference. We are looking at all those expenses that are incurred today, or even incomes that are earned today, but will not be taxed in this financial year. They shall be taxed another time. They shall be taxed like next year. So the most important thing that we've even told us in that statement, that 64 is unrealized, and any unrealized gain will not be taxed in the current year. So please remove it from the 412, take it to the temporary difference like that.
Listen, I would want you to listen to me very, very well. There are things you're supposed to start appreciating now. In an exam, what will happen? Somebody will tell you that we have an inventory. Somebody will come and tell you here, we have inventory. Look at this. We have inventory. We have inventory. Look at this. We have they'll tell you, we have inventory, whose carrying amount is 60. Is 60. And then they'll tell you that unrealized losses, 10. Then they'll ask you to provide the tax base. Can somebody give me this answer, even give them a...
You kindly try that as well yourselves. The carrying amount, what the accountant has calculated here is 60, and then we have unrealized loss of 10. Can you kindly try that? Give me the TB. Give me the TB. So of course, it means automatically that out of this unrealized loss, the taxman will not give you any tax waiver this year, because it can only be given a tax waiver if it is realized. So as you shall be seeing, to get the tax base, unrealized losses will be added back. Unrealized loss will be added back. Like I can see these charts here. Like I can see these charts here. They are getting it. 70, yes. They're getting it. All right.
Present. So in inventory, carrying amount has been given 60. With unrealized losses, what we would also call UPS, unrealized losses over 10. Pata potea. Yeah, most of them are saying 70. Because they know that the accountant, of course, whether realized or unrealized, the accountant must have deducted. To arrive at this 60, the accountant deducted. Because in accounting, we normally provide, we do provisions. We do provisions here. We do what we call provisioning. So the accountant must have deducted. So when the loss is unrealized, then what do? You add. Because you know it has been subtracted, you add. That's what we did here. You see here the unrealized loss was 6.4. Although the language was quite different, the unrealized loss here was 6.4. Once you give me this, to be able to get the tax base, then I will add the unrealized loss. When you give me an unrealized gain, you see unrealized gain means that the figure that you have is overstated. It's overstated. So in this case here, what do? You deduct. You deduct. That's why here, upon them having given us 64 as an unrealized gain, we know that this 412 contains unrealized gain. So what do we do? For gains, we subtract. For losses, to make good, you should always add back. So losses, you shall always add back. Gains, what do? You shall be deducting. They'll become clearer as we progress. Thank you. Let's move on to the next thing. Ladies and gentlemen, the next thing is not number 4. So not number 4, what have they told us? Huruma Limited's loan assets had a carrying amount of 168. So we have what we are calling loan assets. So these guys are giving away out their loans, and then they get, in this case here, interest on their principals back. So these are loan assets. Because you see, an asset is any resource that you have that you're able to control, which gives you an income. All right. So don't take this as a liability. No, it's an asset, it's a loan asset. So the loan asset, fortunately, very good. They have given me the carrying amount. The carrying amount is not disputable. The carrying amount is 168. The carrying amount is 168. And then they're going ahead to tell me that Huruma Limited's loan assets had a carrying amount of 168 million after an allowance for credit losses of 32. Based on a 12-month expected credit loss, tax relief is only available when the specific loan is written off. So this is basically what we call a general allowance. General allowance, a general loss. So a general loss, ladies and gentlemen, basically has been levied here. So then what do you think are we going to do to be able to get tax base? I can see ninjas who are giving me figures already there. What do you think shall we do to be able to get the tax base? What do you think shall we do to be able to get the tax base? Abracadabra. We add back, because you see it's a loss, which this accountant had already done what here? The accountant does not care. The accountant will make a provision and deduct, but now the tax man will say no. So add back. So it is 200. So we are getting, in this case here, a tax temporary difference of negative what here? Negative 32. Loan asset. Loan asset. Loan asset. All right. From there, ladies and gentlemen, you will move very fast to the last item here. Last item. Note number 5. Huruma Limited has unrealized trading losses of shillings 20 million as at 31st March 2021. These unused tax losses arose from a one-off restructuring exercise carried out during the financial year, and it is highly expected that taxable profits will be available in the future. So we have what we call unused tax losses. Unused tax losses or some asset. Because I'm going to draw some income out of this in future in the form of what here? KRA, allowing me to claim. That's as good as getting money. So losses are bad. But in terms of KRA, and this is something you've done in PFT, in terms of KRA, whenever you make losses, you're allowed in this case here to spread that loss and claim for, I think, a maximum of 5 years. Is it 5 or 4 years? The number of years you can spread your loss forward, so long as you have some profit you expect to get. The 5 years, right? 5 years, yes. 5 years, yes. 5 years, yes. All right. So you see the tax base will be the entire amount. I'll be able to claim the entire loss, so long as I have taxable profits against which I'll be able to offset this. So this becomes a very, very good asset for me. 20, the whole amount. The unused tax loss was 20 there. The unused tax loss is 20 there. But you see, for us as accountants, there is no such an asset known as unused tax losses. For us as accountants, ladies and gentlemen, such an asset will not exist in our world. You made losses, I mean, you did that accounting a long time ago. You finished that business. So in this case here, always unused tax losses asset, the carrying amount shall be what here? Shall be 0. The carrying amount shall be 0. The carrying amount shall be 0. Shall be 0. So now you're able to give me, of course, this gives me minus what here? Minus 20. This gives me minus 20. Yeah. And then, of course, I can see number 6 is talking about the 30%. So that is it. So come and give me the total temporary difference. The total temporary difference. Is there somebody who is able to add and deduct where appropriate for you to give me the total? So according to Paul, and today it's only Paul, and that means some other lady there, I've seen they're talking to me, other ninjas today. I don't know what happened. Is there anybody who took a sacrament in church and maybe they don't want to talk? Sacraments are very good, but we have to talk in class. We must talk in class because now we are discussing a very important topic here. So 13.6. So this is the total temporary difference. And therefore, you need to come and now give us what we call the deferred tax. The deferred tax. The deferred tax. So come and give us the deferred tax. So our deferred tax, ladies and gentlemen, shall be 30% of the TD, 30% of the total temporary difference. It shall be 30% of this 13.6. 13.6, which will be equal to what here, somebody, which will be equal to what here, somebody. 30% of the 13.6, which will be equal to something. So according to Paul, I mean, it's 4.08. I don't know whether all of us are able to get this. Yeah, thanks, Lorraine. Good name there, 4.08. So this is the tax arising out of these transactions that we shall not pay in the current year, will be carried forward. So I need to do what we call a tax, a deferred tax account, a DTA. Deferred tax account. So deferred tax account, like this. Deferred tax account. Deferred tax account. So balance brought down will come because it's a liability. So balance brought down. Liability should be credit. So the balance brought down there, I can see from note number 6, I'm being given nil balance. So this is 0. Balance brought down is 0 there. And then now we have our deferred. This balance carried down. This is what you're deferring into the future now. We shall not pay it this year. So balance carried down, 4.08. Fortunately, we don't have any revaluations here. So we shall recognize this in our P&L difference, in our P&L. But of course, knowing that we shall create a liability because nothing is being paid this year. That is the final answer, like that.
Ladies and gentlemen, I'm so happy because I can see you guys were able to follow through this with me like 100%. I got great responses for you. It's a new concept that I'm trying to adopt at RCM, where when we don't have classes like over this lunch hour, lunch hour, I should be able to play like one little video for you guys. We watch it together. All right. And remember, like now, the students who are in my morning, because I teach AFRA, the 5 a.m. class, we also have another time today in the evening where we shall be able to watch a short video. This same video for the students who have just missed this session. Then again, you'll join me at exactly 10 p.m. where we shall be able to discuss this. So that by the time we come for our live Zoom class, like now, tomorrow, 5 a.m., we have a class. If you have watched this, then Mwalimu will be able to do newer, fresh questions from our past papers here to showcase. I mean, where do students get it wrong? So it has been a pleasure hosting you around. And again, for the umpteenth time, I take this opportunity to invite all new students at RCM, students who would want to join RCM. I mean, they should not look further. This is the place to be. Our number is 0719 525,000. And now remember, we have even partnered with HELP for our students here to get the HELP loans. If you would want to get more information on the same, our number is the same, 0719 525,000. Otherwise, thank you very much and bye. Bye.